Welcome to the deep dive. Let's talk private equity secondaries because, well, right now, the sheer number of companies being held by private equity firms is really creating a bottleneck.
Yeah, quite something.
Consider this. By the end of 2023, Bain Analysis showed something like 28,000 companies worth over $3 trillion were just sitting in PE portfolios.
3 trillion, wow.
And what's really striking is that a bigger chunk of those had been held for over 5 years compared to the year before. So, what happens when these investments aren't exiting as planned?
Well, it definitely builds up significant pressure, doesn't it? Pressure for liquidity. Private equity firms, the GPs, and their investors, the LPs, they're ultimately looking for returns.
Of course.
And when the usual ways out, like IPOs or sales, become trickier, maybe because of geopolitical issues or high interest rates, which A&O Sherman mentioned in a report that capital can feel kind of stuck.
Exactly. And that's precisely where the private equity secondary market becomes so important, like a release valve. For anyone who maybe isn't super familiar, secondaries basically involve buying and selling existing stakes in PE funds. So instead of putting money into a brand new fund.
Right. You can buy someone else's existing commitment or even their piece of specific companies within a fund.
And this isn't some tiny niche anymore, is it?
Oh, definitely not. That same A&O Sherman report pointed out that continuation funds, which are a type of GP-led secondary.
Where the firm itself moves assets to a new fund.
Exactly that. They accounted for, get this, 43% of the $72 billion in secondary deals just in the first half of 2024.
43%. So almost half of these deals are now kicked off by the fund managers themselves. That's a huge shift in how liquidity is being generated.
It really is a significant evolution.
Okay, this is where it gets really interesting for investors, I think. We're going to dig into the opportunities this growing secondary market offers, especially for getting exposure to more, let's say, seasoned private equity assets.
Good plan.
And our guides for this deep dive will be some really solid reports. We've got the Private Equity Harvest Report 2025 from Sutton Place Strategies, great for portfolio intelligence and spotting deals.
That's a key one.
And also the JP Morgan Threading the Needle Report, which specifically calls out private equity secondaries as a promising area.
Yeah, lots of good data there.
So let's start with the why. What's really driving this big push for liquidity?
Well, it's a few converging factors, really. Like you said, geopolitical uncertainty, high interest rates. A&O Sherman also mentioned currency swings. They've all made those traditional exits tougher.
Right.
So firms end up holding on to their portfolio companies for longer, naturally.
And that was hit the returns.
It does. PitchBook data, which A&O Sherman cited, showed PE's annualized IRR, the internal rate of return, was actually below 10% in the year up to March 2024.
Below 10. Wow.
Yeah.
When LPs are often targeting, 25%?
Exactly. So you can see how that creates serious pressure for getting capital back to investors, something Sutton Place Strategies really emphasizes.
Right. It's like waiting for the harvest, but the crops are staying in the ground way longer than you planned. And Sutton Place Strategies has a great term for this, stranded assets.
Yes, I saw that.
They define those as companies held for over 6 years. And their Figure 9 shows some sponsors, like Lynx Equity Ltd., have most of their holdings dating back to 2015 or even earlier.
That's a long time in PE terms. Typically, you expect faster cycles.
Definitely.
But what's fascinating is how the secondary market provides a way to deal with these stranded assets and the general liquidity crunch. JP Morgan lays out the two main types.
Okay.
First, you've got LP-led deals. That's where the investors, the LPs, decide to sell their stake in a fund. Pretty straightforward.
Okay. Selling their commitment.
Then you have GP-led deals. This is where the fund manager, the GP, initiates the sale, either selling interest in the fund or sometimes specific portfolio companies into a new vehicle they set up.
The continuation funds we mentioned earlier fall into this.
Precisely. And the growth in these GP-leds is really noticeable. Research from Jefferies, which was mentioned in the Sutton Place report, suggests they now make up about 50% of the total secondary market volume.
50%.
Yeah.
So half the market is now driven by the fund managers themselves finding ways to create liquidity.
Yeah. It means they aren't just waiting for a traditional sale or IPO anymore. They can be much more proactive using the secondary market.
That's a fundamental change in strategy, isn't it? So, okay, if these assets are trading, how are they valued? It's not like looking up a stock ticker.
No, definitely not. Pricing secondaries is more nuanced. It depends on the asset type, the fund's track record, market conditions, lots of factors.
But are there general trends?
There are. Common fund data gives us some good clues. They found that on average, secondary deals across alternatives were priced at about 89% of net asset value, or NAV.
NAV being the estimated current value of the underlying stuff.
Exactly. That was at the end of 2024. And for traditional buyout fund stakes, the average was even higher, around 94% of NAV. So that shows a recovery from lower levels back in 2022.
Okay, 94% for buyouts. But I imagine that varies quite a bit.
Oh, absolutely. That common fund data also showed that deals involving venture capital and growth equity stakes were trading lower, more like 75% of NAV.
75%, quite a discount there.
It is. And real estate secondaries, their pricing recovery has been even slower, so it really highlights that you need to know the specific asset class you're looking at.
Makes sense. What's also catching my eye is the rise of these dedicated funds just for GP-led secondaries. Sutton Place mentioned about $10 billion being raised for those right now.
That's right. Big names, too. Neuberger, Berman, Blue Owl, Leonard Green, Lexington Partners. They're raising significant funds specifically for these GP-led deals.
That feels like a major vote of confidence from the market in this specific type of secondary transaction.
It really does. It signals that the market expects GP-leds to be a big and growing part of the picture. This dedicated capital will likely just pour more fuel on the fire.
And the overall market size is already huge. Sutton Place, using Evercore Research, said it's been over $100 billion a year for 4 years running and hit $160 billion in 2024.
$160 billion. It's substantial. And the fundraising we're seeing suggests this isn't slowing down anytime soon.
So, okay, massive market, lots of activity. Let's flip it around. For an investor, maybe someone listening, what are the actual advantages? Why look at secondaries?
JP Morgan points out several good reasons. First off, diversification.
How so?
Well, by buying into the secondary market, you can get exposure to existing funds across different vintage years, that's the year the fund started, and across different managers, instantly.
So you're putting all your eggs in one new basket. You get a mix straight away.
Precisely. It can help spread risk compared to just backing one or two new funds.
That makes a lot of sense.
Oh.
What else?
Secondly, you potentially get to sidestep that early J-curve you see with primary funds.
The J-curve. That's where returns dip initially because of fees and investments before hopefully going up.
You got it. With secondaries, you're often buying into funds that are more mature. Those initial costs might be absorbed. The companies might be closer to generating value. So, as JP Morgan notes, you could potentially see a return sooner.
Right. So you sort of skip the early, potentially negative part of the timeline.
Potentially, yes. The timeline to possible returns can be shorter.
And we also touched on price, getting in at potentially a better value.
Exactly. JP Morgan also highlights that these deals often happen at a discount to NAV. That can be an attractive entry point compared to investing in a primary fund right at the start.
Okay. So diversification, potentially faster returns, maybe a discount.
And finally, just given the whole environment we've discussed, slower traditional exits. Secondaries are just fundamentally essential right now. They provide that crucial liquidity for LPs who need out and GPs who need to deliver returns.
It really sounds like a market solving multiple problems at once, creating opportunities in the process. Now, the Sutton Place report got really granular, didn't it? Looking at specific sectors where these older, stranded assets might be.
Yes, it did. Their Figure 10 looked at companies by acquisition year and industry. And it showed industrial goods and healthcare have quite a few holdings from that 2013-2018 timeframe.
Suggesting maybe more exit activity coming soon in those sectors?
That's the implication, yes. Firms might be looking to realize value from those longer-held investments.
Did they see different patterns depending on the deal size, like lower, middle, upper market?
They did. In the lower market, that's like $10 to $49 million entry value. Figure 12 showed that for industrial goods, there are about as many companies held 7-10 years as held 5-6 years. Again, pointing to potential near-term activity.
Okay.
And for technology in that lower bracket, the number of 5 by 6 year holdings matched the more recent ones. So maybe an active secondary market there too.
Interesting. And the middle market?
Yeah.
Say $50 to $499 million deals.
There, Figure 14 showed more variation in who's selling. Industrial saw lots of sponsor-to-sponsor deals, one PE firm selling to another.
Right.
But technology in the middle market, a huge chunk, like 72%, were bought from private companies, often VC-backed ones, so the seller profile is quite different.
That could definitely change the dynamics of a secondary deal. And lastly, the big end of town, the upper market, $500 million plus.
According to Figure 16, consumer services there seem to show longer holds. More companies were in that 5-6 year bucket than the 4-year one.
suggesting maybe firms are holding those larger consumer assets longer, perhaps waiting for better conditions or more growth.
That could be it. It suggests holding periods might be stretching out even more for some of those really large deals in certain sectors.
So it's clear, isn't it? The secondary market isn't just one thing. There are layers, sector differences, size differences, lots of nuances.
Absolutely. Understanding those sector and size dynamics is really key if you want to navigate this market well and spot the real opportunities.
Okay, let's try and pull this all together. If there's one main thing listeners should take away today, what would it be?
I'd say it's that the private equity secondary market is not just growing, but it's become a really vital part of the whole PE ecosystem. It's a key mechanism right now for unlocking liquidity when holding periods are getting longer and traditional exits are tougher.
And that creates a pool of more mature PE assets that investors can now access.
Precisely. And it's not just a release valve. It offers real potential advantages for investors.
Right, the diversification, potentially faster returns, the chance to buy at a discount.
All of those. So if you're thinking about investing, understanding the different deal types LP-led versus the growing GP-leds, knowing the pricing trends, and paying attention to those sector insights, like from the Sutton Place report, that's all crucial.
So for anyone looking to get into private equity or maybe just rebalance what they already hold, secondaries offer a really compelling alternative or maybe a complement to just committing to new primary funds.
Exactly. It can be a more strategic way in, potentially less capital intensive upfront, with exposure to assets that are further along their life cycle.
Okay, so here's a final thought to leave everyone with. We're seeing this market get better, more sophisticated, more varied. Could it actually become, a much more central core part of PE investment strategy in the future? Not just an alternative, but a main pillar.
That's a great question.
And if it does, what does that mean for the GPs, the firms, and for the LPs, the investors? Definitely something worth thinking about, drawing on everything we've dug into today. Thanks for joining us on this deep dive.